Central banks will no longer have effects against the global financial crisis. The world witnessed a coordinated financial recovery in 2011. However, now it seems to be diving towards a recession as there are increasing number of recession indicators emerging. Usually, countries could depend on central banks to cushion the economic downturn using economic policies such as financial stimulus. Now, experts caution that central banks will most likely find that their usual stimulus policies to tackle the incoming recession be ineffective. Economists believe that not much can be accomplished in terms of monetary policy to evade the economic downturn. Currently, short-term interest rates are very low worldwide. As financial difficulties rise, business confidence and capital are declining. According to American bank, JPMorgan Chase, retail consumers of products and services are now the primary pillars of worldwide development. They claim worldwide retail revenue numbers grew 4.8% in the last quarter this year. That bump up in consumer spending is mainly due to lower-cost labor markets, but companies are inclined to proceed with retrenchment soon as manufacturing and service orders reduce dramatically. This would then lead to families cutting expenditure, therefore a dramatic reduction of buying power. The export-led countries feel the brunt now. Although France has its as the production operation level rise a little recently, Germany, Europe's financial and manufacturing centre of EU, has experienced 7 months of economic reduction. In UK, manufacturing reduced at the highest pace in the span of 7 years. In the US, the Institute for Supply Management's Factory Index indicates that companies are beginning to undergo faster retrenchment in anticipation of an economic recession. In line with these recession indicators, Andrew Wishart, the economist at Capital Economics, says that a meaningful recovery is unlikely given the ongoing struggles of global manufacturing. Bond trends do not really paint a positive outlook as well. In the US, long-term bond interest rates have inverted. This implies shorter-term bonds yield greater interest rates than longer-term bonds. Historically, this is seen as a warning indicator of an imminent recession. Many countries now see their central banks going towards negative rates. Likewise, President Donald Trump has been urging the Feds for some kind of preventive intervention to slow down the downturn. Trump has tweeted more than 30 occasions in the last month requesting a prominent reduction in the Federal Reserve funds rate. This is the interest rate that banks pay each other to borrow money. On September 18, representatives of the Federal Reserve will meet to decide the direction on interest rates. Boston Fed President Eric Rosengren has already said that reducing rates now not only be ineffective long run but may further harm the economy. Rosengren informed The Washington Post that the U.S. economy is still fairly firm and still has low levels of unemployment. He cites that there is increasing salaries and consumer-led growth. He intends to stop interest rate reductions until there are better indications of financial trouble. Rosengren firmly believes that the Fed's early intervention will imply that fresh rate reductions will have even less effect subsequently if a recession emerges. Some central bankers and economists are concerned that monetary policy instruments will not be enough this time round because they have used much ammo to help the world recover from the 2008 Great Recession. Governor of the Bank of England said that relaxing monetary policies and rates reduction would probably not be enough to prevent a downturn. In fact, interest rates are already below zero in Europe and Japan. With central bank rates very low everywhere, there is little belief that further rates reduction will help. Therefore, there are predictions that central authorities may choose policies of tax reduction to boost profits and economic growth. There also are concerns that many countries are already in historically high public debt, having spent trillions on bonds as part of an effort to spur growth. Piling on more borrowing is risky if gross domestic product doesn't increase. Currencies will start devaluing. Lenders will start demanding higher interest rates. An inflection point will be reached when there are diminishing returns. Currently, there are many nations that are already historically buried in large public debt, having invested trillions in bonds in efforts to boost economic growth. Piling on more lending is dangerous if the GDP does not rise. Devaluing currencies will start introducing uncontrollable inflation. Lenders will start demanding higher interest rates. An inflection point may inevitably be crossed where the reducing growth cannot help to recover the economy but plunge into a downwards spiraling economic situation.